do an introduction, and then we will cover a number of different topics. So those will range from comparing corporate foundations and corporate giving programs. Many of you on the call have both. We'll talk about the difference between public charities and private foundations. We'll talk about the process of corporate foundations going public. We'll do an overview of private foundation rules and the Internal Revenue Code. And then we'll spend a little bit of time at the end talking about regulation before we jump in and start answering a number of your questions. So with that, I'd like to introduce our main speaker today, Suzanne Friday. Suzanne is the Senior Counsel and Vice President of Legal Affairs here at the Council on Foundations. And prior to joining the Council in 2013, Suzanne was a partner at a private firm where she chaired the tax, trust, and estates practice. She has extensive experience working with nonprofits, including community foundations, charitable trusts, private foundations, and corporate foundations. She served as in-house counsel at the Nature Conservancy, and I'll see if I can make her blush a little bit here. She was recently awarded the prestigious Outstanding Nonprofit Lawyer Award by the American Bar Association, which celebrates the work of civic-minded nonprofit lawyers. So we're very, very lucky not only to have Suzanne at the Council, but to have her on the call with us today. And just by way of a little bit of background, many of you have probably heard either directly from Suzanne or from her colleague, Brian Del Rosario. In the past, Suzanne and Brian convened a monthly lunch and learn call that was designed to provide guidance around a number of different legal topics for all of our membership. So as many of you know, we have members really ranging from community foundations, private and family foundations, as well as corporate. But to start the new year, we decided to make these convenings a little bit more specific to foundation type. And what this will do is really allow us to dig a little bit deeper into issues that may be a little bit more relevant for a specific audience. So to that end, again, we are very pleased to welcome you all on the first of 4 of these legal-focused webinars that we're going to do this year. And we'll put out a reminder on this as well, but please be on the lookout for our next webinar, which will be on June 14th. It'll be at 2 p.m., same time as today. And with that, I'll turn it over to Suzanne to kick us off.
All right. Thanks, Jeff. And I have to say I am really so happy that we have Jeff here at the Council now. Corporate foundations have really interesting situations and questions, and I'm sure that some of you out there I have spoken with on the phone or emailed with regarding your questions, but I'm really glad to have the opportunity to focus on corporate foundation topics. But for today, since as Jeff explained, this is the first webinar in a series that we're going to do. So every 3 months we will do one for our corporate members. And I want to say right off the bat that this is going to be a little basic. I feel the need to start from the beginning and to set the stage. So I apologize to you guys out there who may know some of this stuff already, but we're going to kind of start basic. And a lot of what I have in this presentation is driven by the questions and the conversations I have with you guys as our members. As you can see from the slide that's up there right now, we have to put our little disclaimer about not giving tax advice, but hopefully you will get quite a lot of good information out of this session today. So jumping right in, many of you, as Jeff said, may have direct corporate giving programs in your corporation, but also corporate foundations. And so to start the conversation, I'd like to just kind of talk about each one and then compare them. First, corporate giving programs. So corporate giving programs are simply direct giving from the corporation, direct charitable giving. The corporation has not established a separate legal entity to do this, and because of that, they are not governed by all of the laws, the rules, the regulations that do apply to charitable organizations, nonprofit organizations. Direct corporate giving would not normally have an endowment. There's no mechanism to build an endowment at the corporation. The corporation makes charitable gifts when they have funds available in areas that they want to give in, but they don't set up an endowment to ensure that giving continues. Direct corporate giving can be used to include employee matching gifts. If you, as a corporation, want to encourage employee giving, employee matching gifts, the corporation can gift funds to match what employees give. And another really important part, I think, of many corporations' direct giving is in-kind gifts. We see gifts of computers and other technology equipment from those types of companies. We see in-kind gifts from food-related companies to food banks, those kind of things. That's a great way to do direct corporate giving, and you're still entitled to the tax deduction for that kind of giving. Direct corporate giving, if you do have a corporate foundation, many corporations have foundations that have a specific established mission. So for instance, if you're a healthcare corporation, your foundation may have a mission to fund healthcare related charities. Direct corporate giving can be used to make gifts outside of that mission. If it doesn't fit your foundation's mission, the corporation can give directly, and we see this commonly in emergencies and disaster situations where the corporation wants to help out, they want to do some charitable giving. It may not fit the foundation's mission, but certainly the corporation can make that gift directly. Moving on then to corporate foundations. So when a corporation decides it wants a foundation to enable its charitable giving, they would need to form a separate legal entity. So corporate foundations are generally incorporated in the state where the foundation is going to be located by filing corporation papers. They also would then apply to the IRS for tax-exempt status and status as a 501c3 charitable organization. There's nothing wrong with the corporate foundation maintaining close ties with the parent company and giving in a way that reflects what is important to the company and the company's business. Corporate foundations, most commonly we see corporate foundations as private foundations, but they can be public charities as well, public foundations, and the difference is in the funding. We'll get to that in just a minute when we compare public and private, but we do see, and we do have members that are public charities as well as the traditional private foundation that's a corporate foundation. Corporate foundations can set up endowments. So an endowment is simply a principle that is invested to ensure long-term giving, the interest of which is used for the grant making. In our corporate foundation members, we typically see if they do have an endowment, it's a smaller endowment than many of the private family foundations. But endowments are certainly an option for corporate foundations. There's nothing wrong with a corporate foundation not having an endowment, and we do see this also where the corporation makes the gift to the foundation grants out substantially all of that amount. There's nothing wrong with that, but if you do want a endowment, that's an option once you have a foundation. One of the nice things about having an endowment is that corporate foundations, obviously funded by the corporation, can receive funding in years where the corporation is doing really well and revenues are up, but having an endowment is kind of your safety net for those years when revenues may be down and you don't have as much to give for your charitable giving. In that case, you can look to your endowment and you have that endowment ready to go to provide the income to continue grant making so that you encourage and you provide a consistent stream of grant making, which is often a goal of corporate foundations. Once you do decide to establish a foundation, now you are going to be subject to the laws that govern charitable entities. Many federal tax laws will apply to you that would not apply to normal direct corporate giving, and regulations, including regulations on the state level, which is the last part of our talk today. So we often get the question as to why you might want one versus the other, or why you might want both. Corporate giving, direct corporate giving, is obviously a simpler form of giving. and you don't have to worry about maintaining a separate organization. But a foundation can be useful for several reasons. Once the corporation gives money to its foundation, those assets are now segregated in a separate legal entity and therefore are protected from liability that may apply to the corporation, regardless of what that liability is, whether it's creditors or legal settlements that may apply to the corporation. Once the transfer is made to the foundation then owns the assets, and those are generally going to be protected from those liabilities of the company. So that's one nice advantage of setting up a foundation. Foundations can also carry on beyond the life of the corporation, and this might be important for smaller family-owned corporations that envision someday the corporation dissolving or being merged or acquired by another corporation. The foundation can be that legacy, can be that vehicle that carries on the name. And obviously, with the charitable activity it would be doing carries on the name in a very nice way. Foundations, because foundations must be governed by a board of directors, they can incorporate individuals who are not related to the company on the board of directors. And this is nice depending on what the mission is of the foundation, to bring in outside experts in different areas. So again, going back to our healthcare example, if it's a healthcare company and they have a foundation whose mission involves granting to organizations that work in the healthcare field, they can bring in doctors and other experts in healthcare that may not be associated with the company, but can be very helpful sitting on the board and helping to make the decisions regarding grant making from the foundation. And then foundations can eventually become independent from the company, from the founders, if you will. The company is generally the founder of the foundation, but even when that company is sold or is dissolved or is no longer around, the foundation can become independent. This usually requires an endowment to live on. So corporate foundations who don't operate with an endowment are not going to usually live on beyond the life of the company or become independent. But corporate foundations, and I think Ford is a good example of a foundation that began with a company and a family, is now independent of that family and that company, and you built a very large endowment and now is completely self-sufficient and independent. So that's another option for corporate foundations. So as I said, we're going to talk a little bit about the difference between public and private, public charities and private foundations. The main difference is the funding. Where is the funding coming from? Public charities, corporate foundations that are public charities, will get their funding from a variety of sources, not just from the company. If the company is the only funder, then the foundation is going to be a private foundation, because private foundations are funded by one or a small group of funders. Public charities must have a broad base of public support. Private foundations have additional rules under the Internal Revenue Code, and we're going to go through a laundry list of those rules here in a few minutes. But private foundations do have more rules to follow. There are more restrictions on private foundations. So if you are a corporate foundation and you are seeing a lot of outside funding, or funding from your employees, or funding from events that you're holding, you may want to consider or just look into what would it look like if we converted to a public charity. Private foundations have more restrictions on their grant making. They have to do something called expenditure responsibility for many of their grants, which public charities are not required to do. And private foundations are prohibited from lobbying activities. There's an absolute prohibition for private foundations to do this. Private foundations can make grants to other charitable organizations that might do lobbying, but private foundations cannot pay for the lobbying directly and cannot earmark grants to other organizations specifically for lobbying. Public charities, on the other hand, are allowed to do some lobbying. It must be an insubstantial portion of their activities, but they are allowed to do some lobbying. So if the company or the company foundation has any interest in that area, the public charity status may be something to look into. And piggybacking on that, if you are thinking about going public, again, we see this oftentimes where companies have very active employees who contribute to the foundation, or they hold events and get revenue from event ticket purchases and things that involve events that they're holding. To go public, you are going to have to meet the public support test. And it's a calculation. It is found, information about this is found on the Schedule A of IRS Form 990. If you are a private foundation, you're going to be filing IRS Form 990-PF, but public charities file IRS Form 990. And the 990 has a Schedule A, which is where you actually have to calculate how much of your support, how much of your revenue is coming from public sources versus non-public sources. And generally, you need to meet a 33 1/3% test. 33 1/3% of your support needs to come from these public sources. So if it looks like you are meeting that test and you have an interest in going public, and let me back up by saying that you certainly don't have to if you don't want to. If you like maintaining your foundation as a private foundation, even though you might meet the public support test, there's no obligation that says you have to then convert. But if you do have an interest in converting, there is another IRS form, Form 8940, which is what you would file to notify the IRS that you intend to convert to a public charity. And generally, there is a 5-year process. You file your form, and you have 60 months to show the IRS that you are going to consistently meet that 33 1/3% test for public support. And if you can do that, then you will be, from that point on, a public charity.
So I just want to take a quick pause. Thanks, Suzanne, and just remind people that we're collecting questions throughout the call today. So if you do have a question, I know there's no shy people on this call. You can click the Q&A icon to type a question, and then we will collate those at the end, and we'll start addressing them one by one. Thanks.
Okay. Our next slide is really just about this Form 8940 and giving you some of the wording. So 8940 is a form that the IRS uses to allow charitable organizations to make a variety of requests. Again, one of the requests can be to convert from a private foundation to a public charity. And I've just put the wording up there where you're requesting reclassification from the IRS. So now that we've talked about public and private, again, we find here at the Council that a majority of our corporate foundation members are private foundations. They are getting their funding either solely from the corporation or from a very limited number of sources, possibly the corporation and the family that founded the corporation. So therefore, they fall under the category of private foundations. And what I want to get into now is kind of an intro to private foundation law, because as a private foundation, your corporate foundation would be subject to all of the following rules that we find in the Internal Revenue Code. So if you are already a public charity, you don't feel obligated to listen, but you might find something interesting anyway. So these private foundation rules we find in the Internal Revenue Code under Chapter 42, Subchapter A. And there are 6 primary sections that apply to private foundations, again, private foundations only, not the public charities, and impose penalty taxes and additional rules on the private foundations. So we're going to take these one by one very briefly. Jeff and I have decided that future webinars, we will certainly dig in deeper on many of these sections. I know we get an awful lot of questions on self-dealing and how that applies to corporate foundations. Excess business holdings is another area where corporate foundations often have questions. And 4945, the taxable expenditures, is an important section as well. So in future webinars, we're going to take these different sections and really dig in deep and provide examples and do's and don'ts. But for today, I do want to just give an overview of each one of these sections. So starting with section 4940, this is where we get the excise tax on net investment income. All private foundations are required to pay an excise tax on their net investment income. And you might be sitting there saying, but wait, we are a nonprofit, we don't pay tax. And that is true. Like other charities, private foundations pay no income tax. However, this excise tax on net investment income is a separate tax that is imposed on private foundations. And the default amount is 2%, applies to your net investment income. That would be your gross investment income less expenses. That 2%, however, can be reduced to 1% if the private foundation's charitable expenses in the year that you're filing exceed a minimum amount based on the foundation's 5-year average. So basically, the IRS wants to give you a little bit of a break on your excise tax on net investment income if you are distributing more than your average. If it looks like your distributions are exceeding your average, they're going to allow you to reduce that excise tax down to 1%. The calculations are very complicated, and I have to say I'm not an accountant. I don't actually do the calculations or fill out the 990-PF for our members or for any charitable organizations, but they are quite complicated. And one of the things that you may have heard kind of buzzing around Washington and being talked about among lawmakers are proposals to simplify this excise tax. So instead of having this complicated two-tier system of you pay 2%, but you can reduce it to 1%, there have been some proposals and some actual bills introduced that would simplify and make a 1%, another bill I saw was 1.5% tax without the need to do these complicated calculations to try and reduce it. One of the arguments for the simplification is that some foundations, we don't see it a lot in the corporate world, but some foundations tailor their grant making to make sure that they can get the 1% reduction, and that can sometimes discourage grant making or grant making outside of what the normal average is. And we certainly don't want to see anything that's discouraging grant making, so a simplification of this excise tax, in our view, can be a good thing, and the Council has been advocating for that on behalf of our members. The next section in Chapter 42 is 4941, and this is a biggie. This is the self-dealing section, and what it does is basically imposes a penalty tax on the foundation for transactions or activities that are considered self-dealing. And it's intended to prevent the private foundation from being used to benefit what is termed disqualified persons. It also prohibits financial transactions with third parties if that transaction is going to benefit a disqualified person. And it does apply to all private foundations, including corporate foundations. So a couple of slides on self-dealing. What is self-dealing? The code provides a laundry list of different types of transactions, and I've listed some of them here. This is not the full list, but these are the ones that we see most commonly. So things like selling or leasing property between the foundation and a disqualified person, lending money and furnishing goods or services to a disqualified person would all be considered self-dealing transactions. Advertising for a disqualified person. So in the corporate foundation world, advertising often comes up, and that can be a self-dealing transaction. And providing preferential recruitment and business opportunities for disqualified persons is also considered self-dealing. So you may now be asking, well, who is this disqualified person? the code also gives us a nice long definition of who is considered a disqualified person. And so the funder of the foundation in the corporate world, that would be the corporation normally, is going to be considered a disqualified person. So you have to think of the corporation as a person. Individuals at the corporation can also be disqualified persons. Family members of those individuals, certain government officials, other related corporations can be disqualified persons. So just to be clear, in order to invoke this self-dealing rule and to incur the penalty tax, there must be both a transaction, a disallowed transaction, and a disqualified person. Not everyone at a corporation is going to fall under the disqualified person definition. Not every employee at the corporation is going to be a disqualified person, but many of them will be. Board members of the corporation will be. The corporation itself will be. So you really have to understand the definition of who is a disqualified person to know whether you have a transaction with that person. As with many Internal Revenue Code sections, there are always exceptions to the rule, and we do have some very important exceptions to the self-dealing rule. One of the most important is paying compensation for personal services that are reasonable and necessary to carry out the work of the foundation. So if you have a disqualified person, that does not mean you cannot pay them compensation for personal services that are reasonable and necessary to carry on the work of the foundation. Incidental and tenuous benefits to a disqualified person are not going to be considered self-dealing, and in the corporate world it can be seen with public recognition for the company and consumer goodwill that's generated by for the company, and even increased morale of company employees. Foundation giving, foundation grant making, foundation distributions that result in recognition for the company, goodwill for the company, and employee morale are all acceptable benefits that may flow from the work of the foundation, and they're going to be considered incidental and tenuous benefits that will not incur a self-dealing penalty. All right, moving on from self-dealing, we get to 4942, which is, the title of it is kind of strange. It's failure to distribute, meaning you're going to be assessed a penalty tax for failure to distribute a minimum amount each year from your foundation. Many of us refer to this as the 5% payout rule, and you all may be familiar with the 5% payout that is required of private foundations. But this is the section where we get that rule, and it does require private foundations to make qualifying distributions each year in an amount equivalent to 5% of the fair market value of the foundation's non-charitable assets. So if you're a foundation and you run a museum, and the museum and the art collection in the museum is part tied to your charitable mission, those types of assets are not going to be included in this calculation. It's your non-charitable assets. So it's basically your investment income. For corporate foundations, and particularly corporate foundations that do not maintain an endowment, this is rarely a problem, making the required minimum distribution. Many corporate foundations that are members here at the council, money comes in and money goes out, and they rarely ever have a problem making their 5% distribution. If anything, they well exceed the 5% distribution. So this particular section may not be of a big concern to a lot of you, but in the interest of being thorough, we are including it today. I also want to mention that qualifying distributions are not just the grants that the foundation makes, but can also include reasonable and necessary administrative expenses that are needed to run the business of the foundation. This section of the code also provides that a foundation can set aside amounts each year if they are under certain circumstances. Normally, a set aside is going to be money put aside in anticipation of a much larger grant that's going to be made in a few years. and in certain circumstances that can be counted toward the distribution. And there are, as always, penalty taxes that are applied if you fail to make your minimum distribution. All right, moving on to 4943. And I'm just checking the time here. We're doing good. Okay, 4943 is the excess business holding rule. So this says that a private foundation and its disqualified persons together may own no more than 20% of the voting or ownership interest in a business enterprise. A couple of points I want to make about this is a business enterprise does not necessarily have to be a C corporation with stock. It can be a partnership, it can be an LLC, it can be other types of businesses. And you do have to add not only the shares that the foundation holds, but also the shares that the disqualified persons hold, and add them together, and they cannot be any more than 20% total. Now, if the corporation does transfer its stock to the foundation and finds that the foundation, together with other disqualified persons, is exceeding this amount, this code section provides a 5-year period to sell off enough to get you down to the required amount. There is also a 2% de minimis rule, which is helpful particularly in large corporations with lots of stockholders, that even if the foundation together with disqualified people exceed the 20% amount, if the foundation itself only owns 2% or less than 2%, then that's going to be okay. $49.44 is the section that deals with jeopardy investments, and basically this says that you will incur a penalty tax if your foundation is engaging in investments that are likely to jeopardize the ability of the foundation to carry out its exempt purpose. This, again, is another section that we rarely ever see, and one of the reasons that we rarely see this is because, as all foundations are governed by the laws of their state in addition to these federal tax laws, every state, with the exception of Pennsylvania, has something called a MIFA. And a MIFA is a section that talks about how you invest your money, investing it prudently. In fact, the title stands for Uniform Prudent Management of Institutional Funds Act. So if you're a corporate foundation and you have an endowment that you're investing, MIFA would apply to tell you how to invest it in a prudent manner. And because you have to follow the rules of a MIFA, you are almost never going to enter into a jeopardy investment. But this is a section of the code that applies to private foundations, and so we are including it here. Another note on this, foundation managers can be penalized as well as the foundation itself for approving these types of investments. The last section in this group is 4945, and it's called taxable expenditures, and it's kind of a catch-all section where it lists some things that private foundations are not allowed to do, and if they do them, a penalty tax would apply. The big thing, especially for us here in Washington, is lobbying expenditures. This is where we get the rule that says private foundations cannot engage in lobbying or spend money for lobbying. Attempting to influence elections, that is also a no-no. And that is something that also applies to public charities. So unlike public charities who can engage in some amount of lobbying, both public and private cannot engage in electioneering or trying to influence elections. Another taxable expenditure would be grants to individuals for study or travel unless managed according to specific rules. So if you are a corporate foundation and one of the things you do is scholarships, you must be aware of certain rules on how you manage your scholarship process. And this is basically to ensure that the scholarship program is objective, is non-discriminatory, is fair and competitive, and that you're not using the foundation to run a scholarship program that's going to improperly benefit the company. So you cannot run a scholarship program just for individuals that may need specialized training to come work at your company. There are lots of rules related to private foundation scholarships that we here at the Council talk to our members on a daily basis. And if you are running a scholarship program or you think you might want to run a scholarship program, please feel free to reach out to us and we can go into depth on how to run a proper scholarship program. It is possible to run a scholarship program for company employees and their dependents, their children, their relatives. You can run a scholarship program that is limited to that group of people. But again, there are some very specialized rules that you have to follow to ensure that it's fair and competitive and that it's not just a way to funnel additional compensation to your employees tax-free. Other items under 4945, grants to non-charities unless expenditure responsibility is exercised. And the final bullet is grants for non-charitable purposes. And I almost think these two should be flip-flopped because you never want to make a grant from your foundation that is not for a charitable purpose. But you can make a grant from your foundation to an organization that is not itself a charity if it is for a charitable purpose. If you're going to do that, excuse me, if you are going to do that, if you're going to make a grant to a non-charity for a charitable purpose, you have to do what's called expenditure responsibility, which is basically a set of steps, a due diligence process, which is intended to ensure that your grant is truly used for a charitable purpose, even though it may be going to an organization that is non-charitable. We at the Council often see questions in this area where a foundation may want to make a grant to a veterans organization that's not a 501c3 charity or a chamber of commerce that's not a 501c3 charity. They are going to do something that is charitable, but the organization is not itself a charity. And this can be done. You just have to exercise expenditure responsibility. One other area that this comes up is in international grant making. So if you have a corporate foundation that makes grants internationally, unless you get an equivalency determination, which is basically a legal opinion that oversees the foreign organization is the equivalent of a U.S. charity, you're going to have to do expenditure responsibility to ensure that the money that you're sending to that organization is used for a proper charitable purpose. We have lots of information on that topic as well as some really, really helpful information on global grant making on our website. And we have a staff person who is terrific on all things global, Natalie Ross, if you ever need to reach out and have questions in that area. So I'm going to take a pause for a minute before we move on and see, is there any burning questions? We're good? Okay. So the last part of the presentation today is something that I personally think is important and maybe doesn't get as much attention as some of these other tax rules that we are familiar with. And what my plea here today is to know your state regulators. So as a corporate foundation, if you have a corporate foundation, that foundation is incorporated in a state, one of the states here in the United States. Depending on your location. And once you incorporate in your state, you then become subject to certain state laws that govern nonprofit corporations in your state. And being subject to state laws means that you are going to have somebody in state government who is now a regulator of your business. And so my plea here is, do you know your state regulators? In some states, it's the Attorney General's office. The Attorney General takes on the role of the protector of charitable money. In some states, they take this role very seriously, and they can get involved in regulating charities. They can even institute investigations into charities and bring lawsuits against charities that they feel are not acting appropriately. In some states, this may fall under the Secretary of State's office. There's sometimes a charities bureau or other branch of the Secretary of State's office that is your state regulator. And in other states, I know Florida has the office I believe, is under the Department of Agriculture in Florida, which is kind of curious. But so there's no one standard answer for every state, but if you don't know your state regulator or you don't know what office has the power to regulate your operations as a corporate foundation, that would be a very helpful thing to know. I also note on here that many states, I think it's 40 plus states now, have a charitable solicitation registration requirement, which says that if you are a charity and you're in my state and you are going to solicit my citizens for contributions, you need to register with the state so we can know who you are and know something about you. And again, this goes to the state's role in protecting its citizens and regulating charitable activities. I'm sure prompted by instances of inappropriate charitable solicitation and charitable organizations that maybe were not legitimate. So many states now have charitable solicitation registration. Who has to register? Those rules can vary state to state. Many states have, as part of this law, a minimum dollar threshold. In Pennsylvania, where I came from, you did not have to register until you raised $25,000. So if you are under that amount, you don't have the registration requirement. So again, it's very important to know what applies in your state and also in other states where you may be raising funds. And for corporate foundations, this is important because you may think that, well, we are funded 100% by the company, and that's not solicitation. We don't ask the company for money. They just give it to us. It all depends on how your state statute defines solicitation, and that definition can also vary state to state. So I'd be very careful in looking at that statute if you have one in your state that requires a registration, seeing how solicitation is defined. Employee contributions may cause you to fall within that requirement, so you really need to know if and how that would apply to your foundation. If you ever need any help in trying to figure that out, we always love to do research and look at various state laws, so we here at the Council can help you find the right answers to those questions. Continuing on with the state regulation and state regulators, so the state charity regulators have a group that meets at least once a year, and we at the Council like to go and listen into their meetings because we learn a lot. And one of the latest meetings, we heard some of the things that state charity regulators are concerned about right now. And so I included a few that I thought might be interesting to corporate foundations here. These are the things, again, that charity regulators are concerned about. Not that they see them all the time, but these are the things that I guess keep them up at night, and so I thought it might be interesting to mention them here. Absentee boards are a big concern of state charity regulators, and in the corporate world, I don't know that this goes on too much, but if your foundation has a board of directors, if they're not meeting regularly, if they're not actually making the decisions for the foundation, that could be a problem in the eyes of a state regulator. Board and senior staff role reversal. So again, if the staff person or the corporate employee who is charged with running the foundation is making all the decisions and the board is not, that can be a problem. They really do want to see that even though you're a corporate foundation, you have a relationship with your corporate funder, you are still your own organization that is run by your board and not just an extension of a company employee. Lack of internal controls and oversight, kind of along the similar areas. Do you have sufficient systems built in to have oversight of your foundation work, and there's not significant commingling with the corporation? And the bobblehead board, boards that just rubber stamp everything and don't want to actually get seriously involved in decisions of the foundation. Other things, and this is my last slide today, other things that the state charity regulators are seeing on the radar. So excess compensation, this has actually been talked about for quite a few years now among state charity regulators. The IRS also has some interest in this. This is if you're compensating your board or your foundation staff, they want to see that the compensation levels that you're setting, that you're offering these individuals, are reasonable and comparable with other similar organizations. And oftentimes this requires that you get a survey or a study. The council does a salary and benefits study that can give really helpful information on what other similar organizations are paying their staff, and if they pay their board, what they might be paying their board. So being able to show that you've looked at something like that and you're comparing your compensation, and you can say that it is, yes, it is certainly in line with what other similar organizations are paying, that's a very important point. Conflicts of interest is another thing that they're always concerned about. Do you have a conflict of interest policy for the foundation? And is it used? Are there annual disclosures being made by the board members and the staff regarding potential conflicts? And when there is a conflict, is it dealt with properly? And is the review of the conflict noted in the board meeting minutes? Online banking is a new thing that they've highlighted as an area of concern. And primarily, there's nothing wrong with online banking, but what they're concerned about is are proper records being kept. If everything is online, everything in the cloud, are you able to access records that would be needed, for instance, in an audit? Board members and the board of directors being unaware of what's in the IRS Form 990. So the 990, which I referenced earlier, or the 990 PF, if you're a private foundation, is your annual tax return. You're not paying tax, but you have to file an annual return. It includes an awful lot of questions and provides a lot of information about your organization. It's good governance to make sure your board has the opportunity to review the 990, make any comments, ask any questions before it is filed with the IRS each year. Now, we do see foundations that hand out the 990 after it's been filed. That kind of defeats the purpose of allowing the board to see what's in it and be able to question whether or not everything is being reported accurately. So that's something to look at as far as your own operations and see if you're doing that in the best way that you can. And then finally, contributions to foreign charities. One of the easiest ways to support work overseas is to find a U.S. charity that can accept your contribution and will then use it for work overseas. These are usually the friends of organizations. You have the friends of something in another country. And that's an easy grant for you guys to make if it's a valid friends of U.S. charitable organization. If you want to make the grant directly overseas, then there's another set of rules that you have to follow. I mentioned expenditure responsibility, which, again, we are happy to explain more about that if anyone is doing that or has questions about that. But that is basically my presentation for today, which, again, is intended as an overview to get us started in the series. We are going to, Jeff and I will put our heads together to decide what we want to tackle for June, for our webinar in June. And if you guys have any suggestions of any of these sections or topics, or even something that we didn't talk about today that you'd like to see us cover, we would love to hear your suggestions in planning all our future webinars.
Thanks, Suzanne. That was a lot to get through, and we got a lot of questions. So one that we've received that I'll just quickly knock out is that will the PowerPoint deck be available for download? The answer is yes, and you should see on the screen right now my email address, which is jeff.west@cos.org. If you send me an email and request this, then I'll PDF it and shoot it out to you today. And then also I'll just remind everyone that this webinar is being recorded and will be available as soon as we upload it to the website, so you're able to share that with your colleagues or use it for reference again later. So Suzanne, the first question is about recognition. And so what are the rules and opinions on using a company logo for foundation recognition?
Right. That's a great question, and we could talk probably for a good half hour about that. But the basic rule is this. There is nothing wrong with recognizing the company for something that the foundation has done. So if the foundation has made a large grant to something, and say for instance a new hospital is being built and the foundation makes a large grant to help the hospital get built. There's nothing wrong with the hospital recognizing the foundation, but also the company, because the company has funded the foundation. And if it weren't for the company, then that grant would not have happened. What the IRS does not want to see is crossing over the line to advertising. So corporate recognition, a big thank you to ABC Corporation, thank you in an event program, signs and banners recognizing contributors, including the corporation, and even the corporation logo and website is acceptable under the IRS rules. What you don't want to do is start advertising for the company. And the IRS, when they're determining what is advertising, they're looking for things like specific product mentions or links to website pages that have products or language that compares products to other products. So no advertising, but recognition of the corporation and the foundation is perfectly appropriate.
Thanks, Suzanne. The next question is about tax savings benefits. So can you just speak a little bit about the tax deduction or tax saving benefits for public versus private corporate foundations?
Okay, so and that's an interesting question, because when it comes to corporate foundations and corporate giving, the rules for corporations are a little different than the rules are for individuals. So for an individual, for just an individual person who pays taxes, if an individual were to make a large gift to a public charity, the individual could take a tax deduction up to 50% of that individual's net adjusted gross income. If the individual made the same gift to a private foundation, they could only take a tax deduction up to 30% of their adjusted gross income. Now for corporations, corporations are generally limited to a 10% tax deduction. So for the corporation making the gift, there's really not going to be a lot of difference between public and private. Where the difference really comes in is if you're a corporate foundation that also encourages gifts from your employees and from people outside the company and other individuals. If your corporate foundation is public, you're going to be able to tell those people that their gift is deductible up to the maximum extent allowed by law. If you're a private foundation, you're not going to be able to say that. The tax deduction for individuals giving to your corporate foundation is going to be somewhat less.
Okay, thanks, Suzanne. The next question is if we have a private foundation that has just started and it received funding a month before the end of the fiscal year, does the failure to distribute kick in? And how much time is there in this case to distribute?
Yeah, okay. No, generally no. You don't have to distribute for that 1 month, and I'm going to assume that, yeah, you choose to be a calendar year. The way the minimum distribution is calculated, and again, this is a kind of a complicated calculation, but it's, I should probably be careful because I don't have my book in front of me and I don't want to say anything incorrect. But you are going to get, your minimum distribution requirement isn't going to kick in until you've been in operation for that year. So I hope that answers it, but that would be something that I would be very happy to talk offline about. You can email me or give me a call and I can have my book in front of me and I can tell you exactly what the time period is that you would have to satisfy your distribution requirement. And the IRS obviously is going to recognize new organizations are not going to be immediately making grants when they're just getting up and running. So they do give you some time period to get established before this requirement kicks in.
Okay, thanks. We've got about 2 minutes left, so I'm going to ask Suzanne one more question, and then we have a number of very specific questions that have come in, so she and I will put our heads together sometime this afternoon, and we'll make sure to get you an individual response as soon as possible. The last question, I think, is pretty straightforward. Is can a foundation take part in tax credit programs?
Can a corporate foundation take part in tax credit programs? I mean, I think it would depend on the program, but generally, yes, a corporate foundation is equivalent of any charitable foundation, and particularly if it's a public charity. Now, there are some restrictions on private foundations, but there is no difference because you are a corporate foundation in what you can do versus any other foundation. So depending on the tax credit program, I know there are state-level tax credits, there are endowment programs like making contributions to community foundation endowments and things like that that will earn you a tax credit. Remember, if the corporation is the donor, they are generally going to be able to take advantage of many things that any donor would be able to do. So unless there was a specific exclusion written into the tax credit law that says this excludes corporate donors, a corporate donor is going to be able to take advantage of tax credits just like an individual donor would.
Okay, that's going to take us to the end of the call for today. I want to thank Suzanne Friday for that tour de force introduction of legal and tax compliance for corporate grant makers, and thank everyone again for joining. Please do look out for our next legal focus webinar for our corporate members, which will take place on June 14th.
Maybe we should talk all about tax credits.
And everyone enjoy their day. Again, if we didn't get back to all the questions here, we will be responding individually to you all, so please look out for those and enjoy the rest of your day.